I'm Bambi Francisco, and I'm speaking with Mark Mahaney. He's an Internet analyst at Citi Investment Research. Mark has been an II-rated analyst for 2 years in a row. In fact, in 2009, March 2009, Mark called the bottom of Internet stocks, and they had a great year. In fact, many of the stocks that you've covered doubled last year compared to 23% increase for the S&P 500.
Yeah.
So it was a good year, a good call that you made last year. So I'm going to talk to you about this year, 2010. We had a great year last year for Internet stocks. So what about 2010? What does this year look like, and what does that mean for a lot of the private companies who are watching this video?
So the big setup last year was, of course, the recession. We went into the end of 08, beginning of 09 in deep fear mode. It showed up in the valuations for these companies. We refer to it as trough-on-trough valuations. You had stocks trading at their lowest forward multiples, historical forward multiples, on what were that's trough multiple, on what were trough estimates, or recessionally depressed or cyclically depressed estimates. So trough on trough. And so there was, when you figured out when the turn was, or if you got lucky to figure out when the turn was, that meant the stocks could go up as earnings estimates revisions, were upwards, and multiples went up. Like, that was a very unusual environment. Just to say it right out, I don't think we're going to see those kind of returns in public markets in 2010 as you had in 2009. And by the way, we went through a heck of a lot of downward volatility before we reached those that bottom level.
Sure. So maybe not so much of a contraction, maybe some sort of more steady state, but it's an upbeat environment, particularly for private companies, perhaps, and there are many out there that have been doing pretty well despite the downturn. Many out there, LinkedIn, Facebook, Twitter, Hulu, a number of them you and I have talked about. Name some companies you think that public investors would want to buy in an IPO.
Yeah, and so first, there's three interesting themes here. One is there's still secular growth in the Internet, and that kind of survived throughout the recession. Secondly, there's maybe even a greater story to the secular growth because you had some share shifts. Like, you saw some of these public companies, accelerate revenue growth faster than, just improving economic conditions would make you believe would be possible. So the recession may have accelerated the offline to online share shift. Third, you had private companies. Look, if you survive through that recession, you're probably a relatively resilient business model. And finally, just overall fundamentals, you're right, are better. So are there a series of companies out there that I think public investors would be interested in? Forget valuations for now. Sure there are. Facebook at our Citi conference earlier this year may have been the single most mentioned company throughout the conference, and obviously they're still private. Twitter has been mentioned numerous times in public company settings. There's a lot of debate as to whether Google was going to try to buy them. Yelp was another potential acquisition candidate. So from the public market perspective, a lot of these are viewed as potential candidates. But you mentioned Hulu, you mentioned LinkedIn, Demand Media. There's several of these names, Zynga, that are either generating new revenue streams we haven't seen in public markets before, or are just massively taking share in their core niches. And I think public markets, which have not seen any major IPOs in 2 years, and the two Internet IPOs we saw last year were relatively small in cap, well under $1 billion. I think public markets would be very interested in new Internet stocks, secular growth thesis, market share gainers looking for leaders in their categories. There's appetite. And
$400 million, I think in your note you said that you estimated that Zynga was generating in revenue. So that probably qualifies as an IPO this year. What type of valuation do you think a company like that could get?
It's hard to know. Clearly, multiples have come back, so that's good for private companies. We kind of look at the forward multiples in the public companies' stocks, and they seem to be at average forward multiples. I actually don't. What's interesting is, despite the run-up in the stocks, I don't think they're stretched. I don't think they're at peak multiples. That would be a risk. Although it would be good for private companies coming public. But there's a couple of things. If these are companies that have shown profitability or some measure of profitability in some markets, on a sustainable basis, you need to have that. You need to have pretty significant revenues. The more you can get way above that $100 million level, the better. But it also depends on what kind of profits you're generating off of that. And if you can show growth, not growth. If you can show leadership in a particular vertical, if you are the best X, Y, or Z company, show that you dominate a niche.
Social gaming, LinkedIn, and professional networks.
That's right. If you have that story going for you, you survive the recession. You got a clean balance sheet. You got a management team team that people know a little bit or can build up trust in and have been with the companies for a while, it's a pretty good recipe for a public market offering.
You know, Toby, you said something really interesting about how these are new business models, and that's what you're interested in. And so talk a little bit about that. Which of these companies are displaying sort of this new way, almost like Google when Google went public? It was a new model. Pay per search was pretty much a new model for online advertising. So what's interesting out there from a business model perspective?
Yeah, you know, we talked about Zynga. Like, there's something new we've written about it. It's not a great word. We used coined the term microtransactions. But we were just trying to capture something which is in the last 2 years, it's proven that you could generate as an industry $1 billion plus in revenue, not from content subscriptions, but from people willing to, you know, fork over $1, $2, $3 at a time for a particular app. Either you could, you know, invest in it as a public investor with public platforms like Apple, the iPhone App Store, or you could try to find, you know, single vertical gaming plays. There have been very few of those, and Zynga may be one of the first few you really have an opportunity to invest in. But we have not seen this revenue stream before. Like, there's never been $1 billion plus revenue stream and therefore $1 billion plus market cap opportunity out of content subscriptions, but out of content acquisition, content purchases, social gaming, social apps. We're seeing it now. This is new, so there's a real buzz factor about that.
Real excitement, something new to start analyzing and investing in. And just one last question. We talked a little bit before about Facebook and Google going public at a $23-25 billion valuation, and your expectation is that Facebook might even be more than that.
Yeah, you know, I want to be real careful about talking about Facebook valuation, but, you know, clearly given the level of interest in that name at public market conferences, that just the buzz behind that is similar to what, and you've had just as much history in the space as I have, just as similar to me, reminds me of the buzz we heard and was built up around Google when they went public. And we haven't seen any financial numbers on Facebook, so we'll have to see whether they have the kind of S1 that Google had when it went public.
An auction-style IPO.
That too, yeah. We'll see if they'll do something like that.
Or the type of numbers that Google had.
That's right. Specifically, yeah.
All right, Mark, you're going to stick around. We're going to talk about consolidation in the industry, but clearly you heard it here from Mark that there's lots of interest for private companies to go public. Thanks, Mark.
Yeah,
I've been speaking with Mark Mahaney. He's an analyst at Citi Investment Research. I'm Bambi Francisco.